Welcome back to another explainer. We're jumping right into how global geopolitics is literally colliding with high-stakes finance right now. We're looking at a crisis that kicked off with physical ships in a narrow waterway, but almost instantly morphed into one of the most intense financial scrambles of the modern era. We're going to break down the 2026 surge in energy-linked options trading, looking specifically at the cascading effects of the Strait of Hormuz blockade. 90%. Just let that number sink in for a second. We're talking about a staggering 90% drop in ship traffic through the Strait of Hormuz since the late February 2026 blockade began. Imagine a major global artery, one that pumps the absolute lifeblood of the global economy, just suddenly clamping shut. 90% of that traffic completely vanished. So, here is our roadmap for making sense of all this today. 1. The 2026 Hormuz blockade. 2. Demystifying energy options. 3. The trading decision process. 4. The global ripple effect. And 5. The high stakes and hidden risks. Basically, we're going to zoom all the way out to the macro geopolitical crisis, then dive into the actual mechanics of financial survival, and finally, look at exactly how this highly technical trading hits your wallet. Section 1. The 2026 Hormuz blockade. Let's start right at ground zero with the trigger event. Looking at the facts on the timeline, what we've actually seen taking shape is a massively escalating dual blockade. Back in late February 2026, it started with Iranian sea mines, drones, and missiles completely halting commercial ship traffic. By March, the grim reality had set in. 20 million barrels of oil per day were essentially wiped off the global market. Then in April, the U.S. naval counterblockade kicked in, which further restricted ships heading into Iranian ports. And the end result of this dual action, a sudden, brutal cutoff of roughly 20 to 25% of the world's total oil supply, plus 20% of its LNG. Now, this really puts into perspective why standard emergency measures just aren't cutting it. We're looking at a daily deficit of 20 million lost barrels of oil. And the patch for that? An emergency release of 400 million barrels by the International Energy Agency. If you do the math there, that emergency release covers maybe 20 days of the deficit. That's it. And to make matters tighter, alternative pipeline routes in places like Saudi Arabia and the UAE just don't have the capacity to effectively bypass the strait and fix a global supply hole this massive. Moving on to Section 2. Demystifying energy options. Because with the physical supply squeezed this tightly, businesses are frantically looking elsewhere for financial survival. Since the physical oil simply wasn't there, traders pivoted hard to the financial markets, which sparked this massive surge in energy-linked options trading. Now, if you're not super familiar, think of these options basically as high-stakes insurance policies. They're financial contracts that businesses buy to shield themselves from wild market swings. You pay a fee up front, and in return, you get an ironclad guarantee that you can buy or sell energy at a set price somewhere down the line, no matter how chaotic the actual market gets. So there are two main flavors to this insurance. First up are call options, which give you the right to buy at a specific price. Say you're running an airline. You would desperately want to buy a call option to lock in a ceiling price for your jet fuel, right? Because if you don't, a sudden price spike could literally bankrupt you. On the flip side, we've got put options, which give you the right to sell at a specific price. If you're an energy producer, you're buying a put option just in case a ceasefire suddenly gets signed, the strait miraculously reopens, and oil prices totally crash. The absolutely crucial thing to understand here is how this market operates at such a massive scale. And the secret ingredient is leverage. You don't actually need the full cash value of the oil to control the contract. You're just paying a tiny fraction of it. That leverage creates an incredible amount of market liquidity. All of this is happening on standardized digital exchanges, like the CME Group or ICE, which lets traders anywhere in the world react instantly to breaking news out of the Middle East, whether that's a failed ceasefire or a new naval skirmish. All right, Section 3, the trading decision process. How do these incredibly complex trades actually go down in real time? The logic traders use during a crisis like this follows a pretty fascinating step-by-step flow. Step 1, you've got to assess the geopolitical risk. That means meticulously monitoring daily mediation efforts, like the Islamabad talks, trying to guess if the blockade might break. Step 2, evaluate alternative supply. You're checking if non-OPEC countries, say Brazil or Guyana, are pumping out extra oil to help fill that 20 million barrel crater. Step 3, calculate the premium cost. And finally, step 4, you execute the trade through a broker to lock in your price for a future target date, maybe June or July. But keep in mind, executing step 3, calculating that premium cost, is absolutely agonizing right now. Because the market is in full panic mode, the fee to even buy these options has skyrocketed. This financial insurance has become astronomically expensive. We're talking costs tripling or even quadrupling during active military conflicts. You're essentially trying to buy fire insurance while the house next door is actively up in flames. So Wall Street is panicking. But what about the rest of us? Let's zoom back out for section 4. The global ripple effect. Let's trace how all of this trickles down from the trading floor right to your wallet. It all starts with the benchmark price. With ship traffic down 90%, refineries across Europe and Asia suddenly lost access to Middle Eastern crude. That ensuing physical shortage, combined with outright market panic, pushed Brent crude prices surging toward $126 a barrel. And a spike that massive sets off a completely unavoidable cost cascade through the entire global economy. Now, you might be sitting there thinking, okay, what do derivatives traded on digital exchanges by hedge funds actually have to do with me? Well, let's look at exactly how those dominoes fall from the Strait of Hormuz directly to your front door. The impact here is just comprehensive across the board. For airlines and shipping companies, if they didn't already hedge with options, their operating expenses now risk completely exceeding their total revenue. For farmers, it is devastating. 20% of the world's LNG is trapped, and natural gas is a major ingredient for fertilizers like urea and DAP. So trapped LNG means super expensive fertilizer, which directly hikes up your grocery bill. As a consumer, you're seeing it in higher prices at the gas pump and brand new electricity surcharges popping up in your hometown. And for investors, you're looking at extreme portfolio volatility, where your retirement fund can swing wildly based entirely on hourly military news updates. Which brings us to Section 5, High Stakes, Hidden Risks. Because we really need to understand the severe dangers of relying on this options trading as some sort of universal safety net. Believe me, it is far from a perfect system. There are 4 massive risks built into this financial scaffolding. First up, high premiums. They can get so incredibly expensive that they just wipe out the exact savings you were trying to protect in the first place. Second is expiration risk. These contracts have strict deadlines, so if the strait reopens tomorrow and prices normalize, your super expensive insurance option instantly becomes completely worthless. Third, you've got counterparty risk. The institution on the losing side of your massive bet might simply go bankrupt and default. And fourth, policy intervention. Governments can, and do, step in unexpectedly to change margin requirements or trading rules overnight, totally rewriting the rulebook. I want to leave you with this final thought regarding the hidden, highly interconnected costs of our modern world. The physical reality of the Strait of Hormuz and the digital reality of the options market are inextricably linked. If a single naval mine in the Middle East can trigger financial options surge that forces everyday citizens to pay for Wall Street's crisis insurance through higher food and power bills, well, just how fragile is our global energy system? Thanks so much for joining me on this explainer. Keep asking those big questions, and I'll catch you next time.